Well, friends, welcome to today's class. So, last class, cash management and inventory management was going on. We'll continue with that. I'm going for screen sharing right now. Just a minute. You'll be able to see this PPT on your screen. Just confirm if you are able to see it.
Yes, sir. Yes, sir.
Okay. Okay. So,
No,
that
sir.
in within that working capital management, the cash and inventory management, that part we are learning. So, most of the things we have covered. I am taking you to this particular slide. Okay, before that, there are some queries. Rosalie has sent some questions over email. So let me address those questions. That in fact deals with a particular example which is there in our ICSI study method. So let us see that. Then we'll move ahead. Rosalie, this is the question for which you had it out.
Yes, sir.
Okay.
Yes, sir.
Let Meghna rejoin. We'll start the class. Is it visible to you, Meghna?
Yes, sir.
Okay, slides are visible. Now please read this question. We'll be quickly solving this question, then we'll move ahead.
Uh, uh, the annual cash requirement of 8 is 10 lakh. The company has marketable lot sizes of rupees 50 lakh and rupees 1 lakh, rupees 2 lakh, rupees 2 lakh 50,000 and rupees 5 lakh. Cost of conversion of marketable security for lot is rupees 1,000. The company can earn 5% annual yield on its security. You are required to prepare a table indicating which lot size will have to be sold by the company. Also, so that the economic lot size can be obtained by the Baumol's model.
Okay, this question is on cash management. It says the annual requirement of the cash is how much? How much cash company requires per annum?
10, 10 lakh.
10
10
lakh.
lakh. 10 lakh is required. And it says the company has marketable securities in the lot size of 50,000, 1 lakh, 2,000, 2 lakh, uh, 2 lakh 50,000 and rupees 5 lakh. So in
5
these
lakh.
and 5 lakh. So company can invest in these lots. Company can invest either in 50,000 lot or 1 lakh lot or 2 lakh lot. Like this, company can invest in these lots in the form of marketable securities. Whenever cash is required, company can liquidate that marketable securities and get the cash. Okay, these are very short-term investments which can be liquidated at any moment. If you want cash, then you have to what you have to do? You have to liquidate these securities and
Yes, sir.
get cash. Okay,
Convert
the conversion cost. Conversion cost means per transaction. Cost is 1,000 rupees.
yes, sir.
That is your transaction cost, or you can say this is your ordering cost. The company can earn 5% annual yield on these securities. If money is invested in these lots, then what will be the rate of interest?
5%.
5% is the rate of interest. That means when the company is not investing, the company is sacrificing this 5%.
Yes, sir.
Okay, when the company is keeping cash, it is sacrificing this 5%. That 5% will be called as the carrying cost. Ordering cost is 1,000 rupees per order. And what is carrying cost? Carrying cost is a 5%. If you carry cash, when you are carrying means you are not investing. You are not investing means you are sacrificing that interest. That is 5%. Okay, and we have to find out
Yes, sir.
what is the economic ordering quantity or what is the quantity of what's in which size of cash we should invest. What is the lot size? Okay, and using Baumol's model, how we have to do it.
Yes, sir.
Okay, this is the question. Very simple question, but some complexities are involved in one particular issue. That is why that doubt has been raised. And the issue which was asked to me is that this is the solution given to you in the study material. And the question is, lot size is like this. Here only the main question, I think, interest. Why interest rate is calculated like
Yes,
this?
sir.
That means it is divided by 2. I think that is the question. Is it not? You have sent me this photograph. You have asked
Yes,
why
sir.
it is divided by 2. If I have understood, that is your question, right?
Yes, sir.
Okay, now we'll address that issue. First, we'll do the solution to this question. Let us see. First, let us see. Let us solve that question. So, question says this can be the lot side 50,000, 1 lakh, 2 lakh, 2 lakh 50,000, or 5 lakh. These are the possibilities. Is it not?
Yes, sir.
Okay.
Yes, sir.
Okay. And how much money we require annually? 10 lakh.
10 lakh.
10 lakh.
10 lakh money required. So if I withdraw or if I investment in the lot of 50,000, then how many lots will be there?
10 lakh divided by 50,000.
10 lakh divided by 50,000, there will be 20 lots.
20.
Okay, if investments made in the lot size of 1 lakh, there will be 10 lots. Is it not?
Yes, sir.
Investment made in the lot size of 2 lakh, there will be 5 lots. Investment made in the lot of 2.5 lakh, then 4 lots. And if investments made in terms of 5 lakh, there will be only 2 lots. Okay, either we'll invest or we can withdraw in 2 lots. That means 5 lakh twice only we'll withdraw, so that that means once in 6 months we'll withdraw 5 lakh, so annual requirements of 10 lakh can be met. Okay, so this is the requirement, this is the lot
Yes,
size,
sir.
these are the possible lot number of lots. And question has told you per lot, what is the ordering cost or what is the withdrawal cost or what is the transaction cost. Question says per lot cost will be how much?
1,000.
1,000.
1000.
So 20 lots, my ordering cost will be 20,000. 10 lots 10,000, 5 lots 5,000, 4 lots 4,000. Is it not? Okay. And
Yes, sir.
2 lots 2,000. This is my ordering cost. Now coming to carrying cost. Carrying cost means the interest that I am sacrificing. How much I am sacrificing? What the person has done? Okay, my lot size is 50,000. So once I am drawing money, 50,000 rupees is with me. Right? On that 50,000 rupees, the interest I am losing. And rate of interest, question says, is 5% per annum. Is it not?
Yes,
So
sir.
your point is that it should be 50,000 into 5%. But what
Yes, sir.
question has done? 50,000 divided by 2 into 5%. Right? Why it has done? Okay. Now it will understand it with the help of the chart which is shown below. Okay. Are you seeing below? What is the chart? Meghna, you are seeing it. Now it is visible to you.
Yes, sir.
Okay. Now let us say my cash balance is 0 here. Okay, once I liquidate a security, I will be getting 50,000. Is it not? Once I liquidate, immediately I will be getting 50,000. Cash will come up to this level. Is it not?
Yes,
Yes,
sir.
sir.
Okay. Maybe you will be spending that cash. Why you have withdrawn that money? You have withdrawn because you will be spending that cash. When you spend, gradually the cash balance will come down. Maybe in a month, cash balance again coming down and become 0. Is it not?
Yes, sir.
Yes.
Then again, your ordering size is, your lot size is 50,000. Again, will withdraw. Again, cash balance is reaching at 50,000 rupees. Again, you're spending this money, it will become 0. Okay, in a year like this, there will be 20 withdrawals. Again, every withdrawal point, every withdrawal time, cash balance is reaching at 50,000. Then we are spending, making it 0. Then we are withdrawing. Then you are spending, withdrawing. Spending, it is reducing to 0. Withdrawing. Spending, withdrawing. Spending, withdrawing. Spending. Like this, there will be 20 lots. Okay.
Yes, sir.
Now you see, at one point of time, you are having 0 balance, and some other point of time, we are having how much? 50,000. The moment you are withdrawing, it is 50,000. The moment it is comes to zero, it is zero balance. So on an average, if I see, I have to see on an average how much balance, how much cash I am keeping idle. If I am keeping cash idle, then I am losing interest. If I am using cash, then I am not losing interest. But if I am keeping cash idle, then I am losing. So idle cash, how much cash I am keeping idle? 50,000 and zero. Average of these two amounts. Is it not? What is that average? Average is 25,000. Are you getting now?
Yes,
Yes,
sir.
sir.
So on an average, I am keeping idle cash balance of 25,000. Therefore, I am losing interest on 25,000. And that is what the question has done. Right? Instead of writing in the average cash balance, it has taken C by 2. Right? So we are
Yes, sir.
supposed to understand that C by 2 is taken for this logic. So answer is right in the study material. So we have to understand it like this. Is it clear to you?
Yes, sir.
Okay. And similar kind of situation we will be facing uh, in many places. This is like cash management, like debtors management, inventory management, everywhere. You have to face this kind of situation. Okay, if the question is silent, you have to assume that what is the idle balance. You have to do it. Or you have to, no, there is no other option. You have to take the average balance. Okay, is it clear to you right now? Once it is done,
Yes,
I
sir.
think once it is done, then we have to find out what interest is calculated like this. Okay,
Yes, sir.
50,000, then half of that, that 25,000 into 5%. Okay, here it is 1 lakh divided by 2, that is 50,000 into 5%. Like this. This is interest calculation. What is the total cost?
Yes,
You see, this is my carrying cost, this is ordering cost. Total cost, this plus this, taken together is this. I have to find out where total cost is minimum. Total cost is minimum at this point. Is it done? 10,000 is the total cost minimum. Because for 50,000 lot, it is 21,250. For 1 lakh lot, it is 12,500. So total cost is minimum here. Okay, total cost you see, as I keeping on lots, increasing lot size, it is decreasing, reaching a point, then again started increasing. So I should ideally, what should be ideally my lot size?
that
2
should
lakh, is
be
it not?
the
2 lakh should be the, ideally that should be the lot
yes,
size,
2 lakh.
2 lakh rupees. With 2 lakh rupees, my total cost will be, okay. And that is EOQ. And with the help of our model also, we can find out what is the economic stock order quantity or economic cost order quantity. And in this example, it is 2 lakh rupees. We can use this formula which has been taught to you, right? What is this formula you see?
Yes, sir.
2 into, you can say annual projected cash demand into conversion cost or ordering cost, okay, divided by the carrying
Yes,
cost.
sir.
So this is the question. Can you solve this question? You have calculator with you. So
Yes, sir.
if this is the question, so you know projected cash requirement is 10 lakh rupees, conversion cost or ordering cost is 1,000, and interest is 5,000. If I put it in the formula, this is the formula. Is it done? Okay. And you have to take care. 5% means 0.05. If by mistake you write 0.5, then your answer will go wrong. So 5% you have to understand when you're converting a decimal 0.05. You can try it. I'm showing you the answer. Answer is you see 2 lakh rupees. And that is what we have tried. In the previous example in the table also I had shown you. EOQ is 2 lakh.
Yes, yes, sir.
Got the answer?
Yes, sir.
Okay. So like this, if you have any query, then send me the doubt. We will be able to clarify that. Second, one more question has been asked about this. I couldn't understand. Is there any query in this photograph?
No,
Yes.
no, sir. This is the previous one. This is related to
Okay,
the
okay. So
previous
there is no
question.
query
This
involved.
is
So
the same.
I'm skipping this. Now next, is there anything wrong here? This photo also you had sent me.
No, sir. No, sir. This is the question.
No, this is the question. This part I think you have highlighted this part twice period. This was the your doubt.
Yes, sir. Yes, sir.
Okay.
So why that word is twice written there?
I think that is a typographical error. It seems. Secondary are fixed deposits in which balances are held for a specified, it might be specified
Yes, sir.
term period, wrongly typed at specified price period. Either it is fixed deposits are invested for a specified period, or you can say specified term period, you can say like this. Okay, so this is a printing mistake only, no issue. Okay, now coming to methods of cash flow budgeting. Last class we were learning about the cash budgeting various methods. I had taught you all these things, and this is how this process also has been explained to you. This question was explained to you, right? And you can solve these questions.
Yes,
Question is there, answer is there. At home you can try. There is one more question. You can pause the video when you are watching it later on. You have to solve it. I am not solving this question in the class. It will take some time, and we have very limited time. We have to cover the things. You can read the question, and these are the this is also the other part of the question. You can read this question, pause the video, and watch this question. Again, question continues. Then solution starts. I trust you will be able to understand the solution. Once you read the question, you will be able to understand the solve the question. I am skipping it purposefully so that you can do it later on. This question can be solved.
okay.
Okay.
Yes, sir.
Now, now coming to the other part, cash budget for long period, short period cash budget for 3 months, 4 months, 6 months. We have already seen, right? For long period, process is almost same. Okay, but we have to project the inflows and outflows for a longer period. We have to take what is the cash and bank balance at the beginning of the period, then cash inflows like trading profit has to be added, right? So sales proceed and various sources. These are various sources through which you'll be getting cash inflows, right? So trading profits will be added, depreciations and other developments. You see depreciation and other costs, non-cash costs. These are the costs which are charged to the profit. Is it not? Because of this depreciation and other non-cash costs, profit has been reduced. But we are looking for cash flow. So
Yes,
arrive
sir.
at the cash flow, depreciation has to be added, right? Depreciation and other costs which has been written off, that needs to be added. So trading profit, add depreciation, sell proceeds of the assets, proceeds of fresh issue of shares and debenture, reduction of working capital. All these things are needs to be added. Then what are the things that has to be deducted? Let us say dividend paid has to be deducted. Cost of assets purchased has to be deducted because they are cash outflows. Taxes paid, debentures and shares redeemed. Increase in working capital has to be deducted. So this you might face some difficulty in
Yes,
understanding why this reduction of working capital is added and increase in working capital is deducted. Can you understand this, or should I explain?
sir. Yes, sir. How,
Uh,
sir,
I,
how depreciation can be added? It is a,
yeah, please once again speak it out. I'm unable to hear it clearly.
so depreciation is a type of cost, and how can it added with the
Why depreciation is added? You see, we are calculating cash flow. How to calculate cash flow? I am telling you to take the profit. Let us say profit is, let us say profit is 5 lakh rupees. So that is your cash flow. That is a part of the cash
yes,
flow, right?
sir.
You take profit. But when arriving that 5 lakh rupees, you have already deducted depreciation.
Yes, sir.
Is it not? But whether you have paid any cash for depreciation, you have deducted it. But you see, your profit is 5 lakh rupees after deducting depreciation. Only if you add depreciation right now, you will be getting the actual cash profit. Suppose depreciation is 1 lakh rupees. So your actual profit is 6 lakh rupees. Because you charge depreciation 1 lakh, your profit is showing 5 lakh rupees. So when you are taking trading profit and
Yes,
depreciation
sir.
which has been already been charged, since depreciation doesn't involve any cash outflow, you have to add it. Is this point clear?
Yes, sir. Yes, sir.
Now coming to point 5, why reduction of working capital is added? Reduction of working capital except cash, why it is added? Now you see, let me give you an example of one component of working capital. One component of working capital is debtor. Debtor is a current asset or not?
Yes, sir. Current asset.
Debtor is a current asset, right? And debtor is a part of working capital. Let us say opening debtor was 5 lakh rupees and closing debtor was 4 lakh rupees. That means what has happened?
There is a cash inflow.
There is a cash inflow. That means debtor has paid you money. That's why opening balance was 5 lakh rupees, closing balance is 4 lakh rupees. So debtor has paid you money. Since the debtor has paid you money, then what you do? You just add it. That is a kind of cash inflow. That shows that there is a kind of cash inflow. Are you getting?
Yes, sir.
Okay. So like that you have to understand when preparing long-term cash budget, we have to calculate inflows and outflows like this. Okay. Okay. Let's move now.
Yes, sir. Yes, sir.
There is one more question. Again, since it will take a little longer time to solve it, I am leaving it for you. Solve this question. Answers are also given to you, right? You can pause the video and try to solve it. First try to arrive at go through the working notes, then try to solve the question. You'll be able to do it. In case any query, then revert me, so we'll be addressing that question here in the class. Okay. Now, coming
Yes,
to
sir.
other part, managing and controlling cash flows. We know when we talk about cash management, earlier also we have talked about this. Two aspects has to be taken care of. One is accelerating the cash collections. Cash collections, we need to speed up the cash collection areas, and decelerating the cash disbursements. When we are, if some cash payment is required, we can try to delay the cash payments as much as possible. So we need to speed up the collection and reduce the time during which payments, or you can say delay the process of payments. By doing these two things, we'll be able to manage cash properly. When I say delaying the cash payment, doesn't mean that beyond the allowed time, right? Suppose a supplier has allowed you the 45 days credit, then it is always wise to pay him on the 45th day. If you are paying on 45th day, then you are taking the benefit of using cash for the maximum period which is allowed by the supplier, right? So like this, we can accelerate the collections and decelerate the payments. Understood?
Yes, yes, sir.
Okay. Now there are various methods of accelerating cash collection. So quickly, I'll be just going through it. Later on, you can read it. One is concentration banking. That means in different places, in various places, banks can be opened so that customers can directly deposit their checks in those places. They need not send all these cashes to all these checks to the head office or the collection centers. At different places, they can be deposited. So it will ensure the quick collection of cash. This is just one of the methods. Similarly, lock box system in different places, locked boxes can be kept and customer can deposit or drop their checks in those boxes and it can be collected. So that will also ensure quick collection of checks, customer payments. Online transaction, that is very quick. The moment customer sends you money, immediately you will be receiving the payments. These are another way. And when managing, yeah, understood. These are some methods we are talking about how to accelerate cash receipts. Yeah. Any query you have?
No, sir.
Okay. Now coming to this management of floats, when coming to cash management, there are various kinds of floats. Floats mean the time gap. One is, let us say, billing float. That means what is the time gap in billing? For example, suppose you have provided a service to a customer today and you are billing after 3 days. So 3 days delay is from your side. The billing float. Today you provided the service, but you are sending bill after 3 days. You are generating bill after 3 days. So that time gap is called as the billing float. That is time gap in preparing the bill. Similarly, mailing float. That is the time gap when the check is being processed by the post office or messenger. Customer is paying you. Let us say customer is sending you a check. It will take some time to reach at your office. So that is called as the mailing float.
Yes,
That float also can be avoided. Then you got the check, then you are depositing in the bank. So bank will again take 2 days or 3 days to process the check. After that only money will be credited in your account. That is called as the check processing flow, right? Okay. Seller that this check processing flow means when you are in fact arranging the checks and depositing the checks with the banker. That time is called as the check processing flow. The time taken by the banker is called as the banking processing flow. That means you are depositing the check and banker is taking 2 days. That is called as the banking processing flow. So these are the various kinds of floats: billing float, mailing float, check processing float, and banking processing float. We should try to minimize this float. If these floats are minimized, then we'll be able to manage the cash effectively. Okay, that is about receipt side. So controlling payment aspects, we can delay the payment to the extent possible. We can do a kind of payment schedule. You can schedule the payment, or you can in online banking system, we can automatically fix the time by which payment will be released. Controlling outflow of the outflow of cash. So some plan should be made so that cash outflow can be minimized. Determining the optimum cash balance, how much cash we need to keep as our balance that also we need to determine. So these are the some of the things which has to be looked into for controlling cash payments. There are many recent developments in the cash management, like electronic fund transfer. You know that electronically money can be transferred through e-banking. Zero balance account, so account can be opened with different kind of different kind of banks or different branches, and every day the bank balance will be automatically turned to zero. That means final balance will be automatically transferred to the head office, and head office or in the treasury office, the funds can be managed in a better way. So all branch offices balances can be automatically transferred to the head office by the end of the day. So this is called as the zero balance account. Then money market operation. If some surplus cash is there, that can be invested in money market instruments, very short-term instruments, so that some interest can be earned. Petty cash and impress system can be introduced. Main cash can be segregated from petty cash. Management of temporary cash surpluses, that can be invested temporary surpluses. Electronic cash management system can be introduced. Virtual banking, that in extensive with the help of computer, with the help of internet banking system can be done effectively. There are various advantages or various features of electronic cash management system. You can go through it, read it. It saves time, it decreases interest cost, less paperwork, better accounting and accuracy, more control over time and funds, supports electronic payments, faster transfer, speedy conversion of various instruments into cash, makes fund available whenever required, reduction of idle float, ensures no idle funds are invested then and there, interbank balancing is possible, right? Then electronic reconciliation is possible, centralized cash management is possible, early detection and of bookkeeping errors, that is also possible, reduces number of checks issued, fund can be transferred without issuing checks, online transfers are possible, interest income and reduces earns interest income and reduces interest expenses. These are some features of electronic cash management system. Virtual banking or electronic banking or banking through use of IT has got various advantages. It is low cost, it increases the speed, it reduces staffing cost, possibility of improved and range of services being made available rapidly. So these are some theoretical aspects, advantages you can say. Now, one more aspect here we need to cover, that is management of marketable securities. Marketable securities means securities which can be marketed, which can be liquidated at any point of time. You can be quickly invest and you can also quickly liquidate. So three aspects you have to see when you are deciding how, where and how to invest. One is safety. We should invest with minimum risk. Maturity. So when you need cash, so your investment should mature so that you can be able to liquidate it. Marketability, it should be very convenient to make investment, very speed, at a very high speed you should be able to make invest and also liquidate. Cost should be minimum. So there are choices, various options are available, investments in marketable securities like treasury bills, bank deposits, intercorporate deposits, commercial papers, money market instruments, all these things. Some of these are available uh, for corporates only. Some of them are available for individuals as well as corporates. So depending upon the situation, different kind of investment options can be used for. One more question is there. So this is again a very simple short question. You can go through it. I am not covering it here. So you can read the question later on and answer also I am showing you. You can solve the answer. Okay. In case you face any difficulty, then you can in next class you can ask for. Now we'll be entering into the one next
Yes,
area which is about inventory management. Do you
yes.
have any other generalized questions on cash management? Then ask here. Then we'll be entering into inventory management part.
No, sir. No,
Any question?
no, sir.
No.
No,
Okay.
sir.
I'm unable to hear it properly. No, no.
No, sir. No question is there.
Okay, fine. So let us proceed to this inventory management part. Coming to this inventory management, here there are basically three questions which need to be addressed here. Inventory means, what do you understand by inventory? Can you give me some examples that this is what you understand by inventory?
It means stock, like inventory of raw material, inventory of work in progress, inventory of finished goods.
I am unable to hear it clearly. Please speak once again.
Inventory means inventory of raw material, inventory
Okay,
of
all
work in
right.
progress.
So raw material, finished goods, etc. Now, when you are talking about this that kind of inventory management, now three basic questions arises here. First of all, how much to order? Suppose we are thinking of ordering raw material, then what should the quantity for ordering that? How much to order? What is the optimal quantity for ordering? Should I order for 1 ton, 2 ton? Like this, that decision. Then when to order? At what time we have to place the order? Okay, so that we have to decide that this is the appropriate time to place the order. That is one more issue. And third issue is that what is the safety stock? What is the minimum stock we should maintain? Right, at no situation our stock should fall below the safety stock. Okay, so at which point we should place the order? What is the safety stock and how much to order? These are the three main issues which needs to be addressed when coming to inventory management. Now, coming to inventory, there are three major components. As you say, inventory consists of raw material, work in progress, and finished goods. And also, we have learned in a previous chapter and various questions that when we talk about work in progress contains some element of raw material and some element of labor and overheads also. Work in progress is an inventory, but that inventory includes raw material component, labor component, and overhead components also. You know this, is it not? So these are the three major components.
Okay.
Now, when it coming to again inventory managing the cost of inventory. So here we have to understand there are four major costs which are related to inventory. Okay, can you read what are they? One, two, three, four. Just read the main headings. What are these four major costs?
Purchase cost,
Yes, sir.
ordering cost or
First one
setup
is
cost,
purchase cost,
Yeah, then
then ordering cost or setup cost,
okay,
then carrying cost,
okay,
and fourth one is stock out cost.
stock out cost. Okay, so these are various kinds of cost. Okay, time is going to over. We'll continue to the extent possible. First of all, purchase cost. When you purchase inventory, you are able to see the slides now.
Yes,
yes,
sir.
sir.
Okay, purchase cost means when you purchase inventory, you have to pay the price for that. That is the purchase price. That is called as purchasing cost. Ordering cost. Just now we are discussing when you place an order, so you have to incur some cost for transportation, inspection of quality, or processing the order itself, right? Or for chasing the order. That is called as ordering cost or setup cost. To set off a particular order, you have to incur that kind of cost. Then coming to next cost is carrying cost. Just like in cash, you have seen when you are holding cash, you are losing interest. Similarly, when you keep inventory, so the fund is blocked, that interest is lost. Plus, storage cost has to be incurred. There is a possibility of deterioration of the stocks also. There is a possibility of inventory may become obsolete. There will be a possibility of wastage of inventory. So all these are the carrying cost or holding cost of the. Fourth part is stock out cost, right? So stock out cost means if stock will not be there, then you might have to lose a customer. You may not be able to serve a particular customer. If stock is not there, it will bring some kind of idle time. So that cost has to be incurred. So you can say idle time cost of men, idle time cost of machines. And sometimes if customers orders are not met, then some penalty cost also needs to be incurred. So these are the various kinds of cost involved. These are the four kind of cost involved in managing inventory. Okay.
Yes, sir.
Okay. Now how will be learning how to manage it, how to effectively manage the inventory cost. Various options are available. Maybe we can enter into some long-term arrangements with suppliers so that inventory cost can be minimized, or direct supply from the manufacturing location so that there will not be any storage cost. Directly material is supplied as manufacturing cost, that will also reduce. At the time of selling also, it can be sold at the ex factory, that means the factory gate it can be sold. There is no need of storing finished goods. Quantity discounts can be availed. If you purchase in large size, you can avail some discounts. Spot payment discounts, if you make payment promptly, some discounts also you can get, right? And also one more technique, that is ABC analysis, that is segregating invoices on the basis of their value. High value items needs to be properly managed. Okay, ensure that there is always stock of these important items, A category items. Then next important is B category items. Next important is C category items. Like that we can segregate. There are various ways of controlling inventory cost. This is the list of inventory management models, EOQ model,
Please explain the
ABC. Yeah, please.
sir, expected sales. Please tell me again.
I'm unable to listen to you. Please repeat your question.
So that there is a point, the promotion of expected sales of finished good. That point.
Here in this slide, please repeat your question. Please take the speaker nearer to your mouth and speak.
Sir, I'm asking, what is this expected?
No, still I'm unable to hear you properly. Your voice is not clear. Okay, we'll do one thing. Yeah, please ask quickly, otherwise the time going to be over. We can cover it in the next class. Please repeat your question once again.
What is that expected sales, which is given in
X
third
factory
point?
price. X factory prices means just outside the factory. Okay, suppose instead of selling it outside the factory, you have to sell it through your dealer. So this goods has to be transferred to the dealer. Dealer will charge to its commission. Is it not? So that dealer's price is different. X factory price means at the factory gate you have to collect. If you collect, that is the price. After that, transportation cost will be there. Various kinds of commissions will be involved. So excluding that thing, if you straightway sell it at the factory gate, then other costs will not be there. That is the point. X factory price.
Yes.
Okay, understood. Well, we are talking about these are various inventory management